Okay, so let's have a look first of all into a few parts. So we have income statement, balance sheet, and cash flow. Into the income statement, we see the revenues, we see the gross profit of the company, we see the expenses that they have during their quarter. They are basically operating expenses. Then you see what is the net income before tax and also after tax. So that's the net income after tax. And then also what you will see is the number of average share diluted. Okay, so you have different options into the income statement that you can look at. Normally, what you look into a company, you look basically if a company is growing. So how do you understand if a company is growing? You look into the revenues. So over here, you see the revenues. This is the total revenues of a company. In this case, this is OBLN, okay? And that's on the annual. So we can click into the quarter. And then you look at the company, okay? So you will see that on the 3/31/2019, they had $1.77 million into revenue. Okay, then they have 0.39 million, 0.33 million, and so on and so on and so. Okay, so if you see here, there is a decline into the company revenues. So the company is not making the same money as before. Okay, you can see also. Okay. So later on, what you will see is also what is the total operating expenses of the company. Okay, so here in this line over here, you will see basically what are the expenses of the company. In this case, the company, together with the revenue, okay, the expenses are going down. So maybe they finish with new research on products and whatever. So they are disinvesting into assets. Maybe they are cutting out people. So basically, the operating expenses are declining. Okay, so this is a fact that you can see also over here, the revenue. So most probably this company is disinvesting. Over here you see the net income. Okay, so basically the net income is basically the value of the total revenue. Okay, the selling and general administrative. So over here, you will see some profit. Selling, general and administrative. Okay, so is the total of this, and sorry, this part is on the expenses. And basically, you will see these are the expenses. It's not the income. Over here is the income. So these are the expenses, and here basically you will see a negative income because if you have lower revenue and more expenses, and these expenses are calculated with the selling, general, and administrative in this case, in this voice over here, you will see a negative income. So this company, based on this revenue and these expenses, is losing this money normally. Now, a way to survive for some company with net income that is always negative is by doing offering. How do you see into an income statement if a company is doing offering? You have over here are diluted average shares. You can see over here. Okay, you see here this is the float of the company. In this case, we have 7.77 millions, and if you look in June 2019, they have 2.69 millions. Okay, so basically this company have done some offering. They increase their average shares. Okay, and basically that's how they maintain a little bit a survival during this low in revenues. Okay, their survival. So basically they are surviving by doing offerings, but they don't do so much offerings, and they still keep a 7.77 millions. Now, one thing that you do to calculate your EPS, okay, the earning per share, is basically you take your net income and you divide by the diluted average share. So here you have this one, you divide by this, and that's your result. So this is your basically EPS, earning per share. And what you can do if you want to calculate, okay, if a company has upcoming good earning per share, or basically they will beat estimate or not, you look at the diluted average share. You look at the latest quarter that they are going to announce if they have done any offering, okay, and then you will add to the previous quarter the new shares that are diluted, okay. You will look basically at the trend line of revenues or income, so you just can look at the net income. Okay, so if they have a trend line that is above, normally it's growing every 2 millions, 3 millions, or it's declining, okay? So basically what you do is you add this trend, and then you divide by the number of new diluted average shares. And that's basically is going to give you approximately, okay, what will be the estimation of your new EPS. We can go further to cash flow. This is again by quarter. Okay, so over here you have again the net income. That we discussed before. So this is basically the revenues minus the operating expenses. And then over here, if we go down directly, we don't need to go on all of them, all the voices. What you will see is the net cash beginning balance, net cash ending balance. And this is the net change in cash. So if you see this number, depends, sometimes they are declining, sometimes they are straight up, okay? But this is based on the latest offering. So here what you see is that they had 14 millions by the 3/31/2020, and they spent during that quarter 5 million, so they remained with 8.9 million. Okay. So over here, during this quarter, they did not spend over here 6.8 million. They had on the expenses is this quarter plus this quarter is giving a total value of 0.725. Okay, so this is the total of the 2 quarters. So over here, you see that basically they had 6.8 million, and so and so and so. So at the end, this company, as you can calculate their average burning rate, okay, by this trend over here. So you will see that basically they lose something like 1.5 million every quarter. So if you consider that they lose 1.5 million every quarter, what you will see over here is that from 3.9 on the next quarter, they should have about $2.4 million. Okay, so that's what will be in the next quarter, considering these expenses, okay, their ending balance. Any question for now? And if yes, where I can go, Arden, for the question? Which channel? Trading Go?
Yeah, you can. They can ask in Trading Room. That's the public one.
Okay.
Trading
So
Room.
if you have any question, just let me know. So I'm in the Trading Goal. Is everything clear? Okay. Okay, clear, Rick. So this is going to be recorded. We can look at other companies if you like. So we can go over here and add some other company. I'm going to do UMC. That is one of the great one. So this is the annual. We go by quarter. So what you will see here is that the revenue of the company are increasing. You see, by 2019, each quarter is increasing. And what you will see here is that the operating income, it's increasing, okay? The net income before tax and the net income, you can see here, basically it is increasing. So they had from 1 billion, they are now at 11 billion. Okay, that's their net income. And then the reason, and then you will see here also the average share, that they are steady. At least they decline a bit. They sold some of the share most probably over here. NIO fundamentals. Let's have a look at NIO fundamentals. NIO. Sorry, NIO is in Italian. Okay, so we go by quarter. What you see in NIO is that in 2018, the revenues were 3 billions. Now we are at 4.5 billions. So this company has revenues that are going up. But you can see here that in the past, they had cost of revenues that was higher than the normal revenues. Okay, so you see 1.6 billion and here 1.8 billion. So the cost of revenues, here 1.5 to 2, 1.8 to 2, 2.8 by 3.4. And over here, in these last two quarters, 9/30/2020 and 6/30/2020, what you see is that the cost of revenue for the first time, it's lower than the total revenue. So the company is moving from a negative profit to a gross profit. Okay, of course, the operating expenses over here, they are more stable. There is a little bit of increasement, sometimes of decline, and basically this is the operating expenses that are going to influence the net income of the company. Okay, but you will see here as well that the net income of the company, because of the operating expenses and because also this revenue are increasing, yeah, the net income of the company is slowly going better. Okay, you will see also the trend here. So you can see that it's trending a bit on the upper side. So this company, according to what you see here, okay, so they have revenues and they have the revenues that now are higher than the cost of revenues. So they are going into gross profit. Now, what you can see as well that they have expenses. Part of the expenses is also paying out liabilities and whatever. So you can go into the balance sheet. You will see the total asset of the company. So here is the cash, what they have. You can see in the last quarter. Okay, the cash over here. The cash is short-term investment. Over here you will see the property and plant. So these are major assets that are basically like, yes, factories or whatever. And here you have the total asset of the company. Okay, so that's calculated with the cash and the property asset and long-term investment. Over here, down here, you will start to see the liabilities. You will see basically short-term debts. You will see basically the long-term debts. Over here, you will see as well the long-term debts. So this company, 2018, has these debts, and now they grow up big time, and they was around 7 billions, and now they're still steady. So basically, they are always around this area. So the debts are not really the debts are not really going down, they are stable. You will see here the amount of total debts that is basically calculated with short terms, long terms, and everything. Okay, and then there are other liabilities. Other liabilities are just called other liabilities because they are not so important. They are like really short-term debts or whatever. So what companies do normally as well, when you want to look into something, is you check the shareholder equity. So what is the shareholder equity? The shareholder equity, it's showing you basically if a company, okay, if a company has a good values compared to their debts. So basically is the difference, okay, between the assets and the liabilities. So you will see over here the total equity of the company. So it's the difference between the total assets versus the total liabilities. When a company have an equity that is also increasing, like what you see here, okay, in the past it was a bit in the shade, but now they are growing, it means that the value of the company is also increasing. Basically because of the assets now, okay, their investment that they have done and their assets right now are much better than the debts that they have. Okay, so this company at the moment has better liabilities compared to the past. This company at the moment, compared in the income statement, they have right now, as you can see, that the total revenues, okay, for the first time in the past few quarters, they have been over the cost of revenue, and also the net income as growing compared to the past. So this company is doing better, okay, and that's what you look at. Then you look at the cash flow, and there is not so much here. It's 2018. Sorry, I cannot really look into the quarter of this. So anyway, if you look at the revenues, cost of revenues, net income, okay, and you look at this trend over here, then you look at the balance sheet, and then you go down to the shareholder equity, where you can see if the company basically it's doing better or not, okay, asset value above liabilities. Then basically you can understand if you are in a good company or not. And there is no annual quarter over this one. This is clear and it all makes sense. So let's say we are researching a particular sector and you will find a couple of companies with similar growth through the years. What are the most important metrics here that could tell you that one is better than others or more project growth? Well, this is more, you have to look at the sector, okay? So the same sector, you look at their shareholder equities, okay? And basically you are going to look how the company is investing the money, where they are investing the money of their loans, their debts, and their liabilities. So where they are investing, you go into their balance sheets, okay? Not here, but you can go directly on the SEC, and you will compare them. How you compare them? There are companies that are overvalued. For example, let's say UMC. UMC is a semiconductor company, okay, from Taiwan. This company has a float of 2.29 billions. The market cap of this company is 24 billions compared of, it's basically calculated by the price, actual price by the outstanding share, okay? So that's basically by the float. So that's basically how you get your market cap. Okay, so over there, what you need to do is you look at this revenue, you look how this company grow. Do not forget this number, okay? We look at this. The net income is growing in the semiconductor company like this, and now it's 11 billion. And they have approximately 2.29 billion companies. Now we go to TSM, Taiwan Semiconductor Company. They have 4 billion, the doubles, okay? And their market cap is 545 billions, okay? So what you need to do over here is, if you divide by 2, you get almost the same shares of UMC. So you will see that this company is valued by 245 billions if the float were the same, okay? So now what we look is at number of this company. We go here, we look at the quarter, So this company have huge numbers. The net income and whatever. And what you look as well is if they are stable, how it's growing over here. Okay? So basically, you will see that this company is still making money, is a money maker. They double compared to their market. Okay, they double, and it's valued right now based on this asset. Right now, it's valued $545 billion. So if you compare the same sector, okay, and you will see how the numbers are, what you can say is that right now, compared to this company, UMC, I don't see it's better than TSM, but I believe it's undervalued. I believe it's undervalued, and their market cap based on what they have over here, okay, so if you look at them, they have about 350 millions here. I don't remember how much they have, but basically this company, it should trade, in my opinion, around $14 right now. So it's more complicated to explain in a short time, and I need to prepare the lesson to make a comparison. I have something as well to compare them, but you have to go into Yahoo Finance, look at the sector, look a few datas. I think I can do next week. I have no problem with that, and we go into comparison. No problem, Rick. Any other question? No question?
If you guys do have any questions for Monster, you can just ask away in the trading room, and he has some time right now.
So, again, income statement, you can find this on the balance sheet of the company. You will look at the total revenue. You look if the revenue are growing. You look if the cost of revenue is going down. This means that basically the company is making more money than before. Okay, so the gross profit, if it's increasing or not. Then you look at their expenses. Okay, if the expenses maintain anyway a positive net income. If the expenses are above the revenues, this means that this company is spending more than what they make. So to survive, this company has anyway to make offerings. So if you look, for example, at company like Zoom, let's say, okay, that's the worst case, okay? So we go into Zoom. So this company has zero revenues over here. Do you see total revenues zero, and they have total operating expenses of 4 millions, 5 millions, 5 millions, 300, so they have expenses. How this company that have zero revenues can survive? So this company is surviving by this voice over here, diluted average shares. You will see over here that the numbers are increasing, okay? Over here, very simple. This means this company is doing offering to maintain positive cash, to pay their liabilities, their operating expenses, and whatever. A zero revenue company is a company that doesn't make any profit. It's a company that have only expenses. Most of the biotech companies are zero revenues. They have only expenses. Okay, so the way they survive is by offering. So what you do, you just look at their normal expenses. Okay, so that's what they have. Now they have 61 millions, but you have to look basically how much they were spending in the past. Yeah, they are doing always offering, so it's even difficult to calculate. But now they have 61 millions. Okay, that's because of the offering they have all the time. And now they have 61 million over here, based on that. But there are not expenses upside down over here. Very strange. But in any case, that's what you look at. Then If you look at the operating expenses over here, you can see that's what they spend normally every month. Okay, 5 millions, 5 millions, 5 millions. So if they have zero revenues and they have only 5 millions on their cash flow, okay, this means that this company is going to do another offering to maintain a positive cash flow to pay their operating expenses. Any other question? Okay.
We had
If no
somebody.
questions,
We had someone ask, since OTC has such a large number of shares, they're usually overvalued. How can you distinguish a good OTC company from a bad one with the fundamental research you're looking at?
I don't do OTC normally because OTC are not so regulated.
Yeah.
So yeah, I never do DD on OTC. I don't look at their balance sheet. Sometimes you see strange numbers into OTC companies, so I cannot trust them. They are not regulated, you know. So it's very difficult. I mean, I'm not an expert into OTC. And yeah, you can look at the revenues. You can look also at these numbers, and then maybe the numbers are okay, maybe the numbers are fake. That's something I don't know.
Thank you. And then one other question was, could you compare the fundamentals between LMND and CLOV? Lemonade and Clover Health.
Wow. That take times. I cannot do like this easily.
Yeah.
LMND.
I think
LMND.
what kind of questions Monster's looking for is like something where he can help you guys better understand what he's talking about right now, not so much looking into other companies.
You guys have to do this comparison. You know, I'm giving you the tools to make it.
Yeah.
So you just look at the revenues, you just look at the numbers, and then you decide, okay, this company is good or this company is bad. You know, that's based on fundamentals. If you want to do a long-term investment, if you want to invest and make a proper, safe investment, let's call it, okay, into a company, what you look is this company going to do an offering? Is this company going bankrupted? Is this company have good financial sustainability? So how this company is doing compared to another in terms of financial sustainability. So the revenues, you compare the cash flow, you know, the expenses that they have. So that's things that you can calculate. So then you go to the SEC file, you see for any prospectus, I have different tools, okay? But then you can do anyway. You look for prospectus, you look if they have open offering that they can do anytime, and then you look at their cash ratio, okay? So you go on the cash flow, you see how much cash they have. This company have enough cash over here. But they had, I don't know, this is a new quoted company, LMND? No.
Yeah, I think it's a new IPO, maybe.
Yeah, it's look like, but that's yeah, that's Clove, yeah. With Clove, I've done a DD. I can share with you later. But what I found strange in Clove is that the company number of Clove, okay, is the same as the company number of another company with the same director of Clove, and this company has at the moment is into court to pay something like $250 million for something that I really don't understand, but I can share with you. I will look into my Twitter account and I will share it.
Sweet. And you got one question that was more about the specifics here, if you saw it in the trading room. Can you explain the importance of market cap, outstanding floats, and those types of statistics to spot good plays?
Well, market cap, what is market cap? The market cap is basically the shares by the price, you know, and then basically you get the market cap. So if a company like Zone with zero revenues, so let's say Zone, Zoom had 0 revenues. Okay, guys, you don't have to look at this sheet. Okay, this is from 0.07 it went to $2.50, but that's because we were in a bubble. Okay, so we were in a bubble. There was basically enthusiastic. Every people was euphoric about the stock market. Everybody buy. There was algo machine on, and things like this went nuts. Okay, but a company like this with 0 revenues and with a market cap over here when it was $2.5 billion, okay, $2.5, it was almost 2 points, what was 2.4 billions. The market cap, this is the value of the company in the market. So a company with 0 revenues that is valued at 2.4 billions is overvalued. A company with 0 revenues, like Zoom, with 0 revenues, with $2.5 billion market cap, that is the value of the company into the market, okay, is overvalued. That's how you understand if this company basically is a bubble or not. How it's possible that a company like Zone has a market cap of $874 million right now, okay, when they have 0 revenues. When they have just expenses, they are making no profit at all, and the only way how they make the money is by offering. So that's basically what you look at. Now, we was in a bubble, okay? That's something you have to understand. We was in a bubble and everything was speculative and everything was running. But you see here, now it's going back. And most probably, if the bubble will not pop up again, because here I believe in March, around March, we start to have this bearish market that I was talking about. It's almost 1 month. Okay, and then basically you will see that everything is downtrending and it's going back to their normal value. But right now, Zoom, for example, in my opinion, still overvalued. So what we need to understand is what is the market sentiment, how the market is moving all the stocks, okay? This was unusual. It's something that you have never seen in the years before, okay? All these type of things. Never. So it was just euphorism from retails and algo machine on from hedge fund and market maker. Nothing else. But this company has 19 employees. 19. And watching here. And they have 0 revenues. That's the importance. So now, are you going to swing Zoom? If you look at the fundamentals, for me, Zoom should go more down. For me. Okay? Then maybe some people by the chart is going to say, oh no, this is a good support. You see, it's bouncing on the EMA 200 over here. You have the EMA 200, it's bouncing over there. It's crossed the EMA 8, it's doing a reversal. This is going to move again. Okay, it's true. It can also move again. You know, it's depending from the people if they are willing to buy a company like this and risk their money or not. I don't say that it's not possible. It's even possible. But if you look at the fundamentals, you will never invest into a company like this. Okay? If you want just speculative things, then that's what you do. This is clear and it makes sense. So let's say we are researching a particular sector and you found a couple of companies with similar growth through the years. What are the most important metrics here that could tell you that one is better than the others or a small project grow? Okay, so what you look is how they invest their money. If a company, okay, has a lot of cash, it's no good. If a company is using the cash to invest into new assets, so their asset value is increasing, okay, this is a company that is investing into the future. That's what you can compare sometimes, okay? Having too much cash is not good. Not having cash is not good, but having too much cash and not investing into new asset value is a company that is not growing. Is a company that doesn't look to grow, doesn't want to expand. So when you look at the good company that is expanding, you will see that their asset values are increasing as well. Okay? They are paying liabilities and whatever. So we look at UMC. Again, You go over here. Their assets are stable, but in 2019 it was 146 million here. The total asset over here from 374, they are stable, 377, okay? Okay, they have a lot of assets, by the way. But what you see over here is that the liabilities went down. So this company, how they have used cash. The asset did not grow, they are stable, okay? But the liabilities goes down. So they are paying with their cash the liabilities. So that's how this company basically is reducing the debts. But in the meantime, this company, okay, has good assets, that they are stable. If you look now at TMS, maybe we should look at TSM, sorry, maybe we should look into the yearly. It's much better. Balance sheet. So what you see here is that watching this company, total asset. You see here, watching these numbers. These are growing. So this company is investing. This company is a company that invests, okay? So that's really important. You see the cash here? They have not so much cash, but they are investing into assets. That's what you look at. Of course, also the liability increase with this company because they are investing into assets, okay? So they use loans, liabilities, debts to buy assets as well. Because as you can see here, the cash, okay, it's stable around this level. And if we look, that was the balance sheet in the annual. Let's look at UMC annual. Balance sheets. Okay, so here we have the assets, total asset of UMC. You see here that basically this company is growing. Now it's stable around 394. This I don't know this number, it's billions maybe. And the liabilities have been over up here. But you can see that they went up and now they're going down again. Okay, so they have the cash is stable, it's growing a bit. This company is not investing so much into new assets. The cash is increasing, but I believe this company it's going to invest into new assets soon because you can see here the assets are growing as well into. This is just the short terms with cash, but the property they have been increasing as well. You see here the property assets. Okay, so these assets are increasing as well. So this company is investing. So what you have to look is this. How company is using their money. They pay debts? Yes. They increase the asset? Yes. Is this company paying debts and increasing assets better than other companies? Yes or not? These are numbers you have to check and focus on it, okay? So you look at the sector and then you look at how growing their asset value, the shareholder equity, how it's growing, you know? So that's basically what you should look. And you can compare this as well into another sector. Any other question? A fast-growing company can also be dangerous. There's something to look for to distinguish that. Too many assets and debt can quickly drain the income. Well, it's depend on which sector they are investing. So, for example, if today you want to you want to open a company, your company want to be an oil and gas company into a market where into a world that is trying to turn into renewable energy, okay, then of course it's a bit dangerous to invest into a company, into a new oil and gas company. So you have to look basically what the future it will be, you know, in our macroeconomics conditions. So if a company is growing too fast, but it's a market that is very healthy, maybe it's not dangerous. Okay. If no more question, I think we are done.
It doesn't look like we have any more questions, but thanks, Monster, for doing that. That was a really, really great stream for everyone who was lucky enough to join and watch. And I recorded it all, so I'll send you that video and you can do whatever you want with it.
Yeah, send the video to the guys over here, and maybe we can open a channel, a public channel with videos we can add.
Yeah, well, we can put the video, the recorded one, we can put that in your channel so everyone can see it. We can leave it up there.
Yeah. Okay, no problem.
All right, sweet.
Okay, guys, thank you, guys and girls. Have a good Sunday. I will prepare my luggage. I have to travel to Italy tomorrow.
Safe travels.